just want to tell you that I finally bought that XYZ ETF that you were mentioning about the other day. I'm just so happy that I'm finally investing in the stock market.
No, I said XYZ index fund.
Yeah, but they all look the same. What's the difference?
A lot actually, but the one thing that all three have in common is the word fund. Think of fund as one big basket, each basket holding different types of underlying investments such as stocks and bonds. Therefore, by investing in one of these funds, you're able to get some diversification benefit compared to buying a single stocks or shares. Before we get into the detail of talking about all three types of funds, their advantages and disadvantages, can I please remind you to hit that beautiful like button for me and subscribe to this channel as I upload every week talking about all things investing and personal finance. Hi guys, I hope you're all keeping nice and warm. So today we're going to try and understand everything we need to know about mutual funds, index funds and ETFs. Starting from the beginning, mutual funds are the oldest of the lot. The first mutual fund was launched in the year 1924 and it was called MFS, Massachusetts Investor Fund. Fun fact, the fund is still going strong and it is managing over 6.5 billion of US dollar. So back in the 1900s, right after the First World War, rich folks wanted to make even more money by moving away from individually investing in stocks and shares to investing in stocks and shares with other rich folks, giving them the benefit of economies of scale. And that is because it is much easier for, say, 1,000 people to own a significant amount of ownership in a company stock or a share in, say, 10 different types of companies compared to one person trying to do the same. And so, in order to meet that demand, a vehicle was launched, which pulled all these people's money in one place, ready to be mutually invested in different numbers of stocks and shares, hence the word mutual fund. Soon enough, the idea of mutually investing in stocks and shares became very popular, and these mutual funds were popping up everywhere. And so there was a sudden demand and opportunity for people who are well versed in the business of stock market to start charging people to professionally manage that pool of money. However, the problem was some of these professional people, called fund managers, were charging way too much money and were not even able to beat the overall stock market. And so Jack Bogle pioneered what we now know as index funds, first launched in the year 1975. Jack Bogle believed in investing in the overall stock market rather than trying to beat it. As a result, he brought the fees down much lower to a fraction of what the active mutual fund managers were charging. Jack Bogle's company, Vanguard Group, was the first to launch index funds, tracking the overall performance of the stock market S&P 500. And as the idea of low-fee passive investing started to get more traction, in came the ETF. The first ETF was launched in 1993, again trying to track the overall performance of S&P 500. Now you must be thinking, which genius thought of launching an ETF tracking the S&P 500, which was already being done by Vanguard Group? Well, I think it's time for the details. To start with, understand that there are only two simple branches that any of these funds will belong to, and they are active versus passive. So, a mutual fund can be both active or passive. Passive mutual funds are what we know as the index fund, while an active mutual fund is, well, just known as the mutual fund. So, with active mutual funds, the purpose is to beat or outperform the overall stock market. So if the stock market goes up by 10%, they will try and beat that number and give you a return of, say, 15%. With the index funds, however, they will just give you the stock market. So if the stock market goes up by 5%, you get 5%. If it goes down by 50%, well, you lose 50% of your investment values. And finally, the ETF, or the exchange traded fund. A lot of people think that it is only a passive investment. There are, however, some actively managed ETFs out there. However, most of the ETFs are rather passive, so it will try to give you a performance of whatever it is set out to track or follow. This could include a stock market index or even a price of gold or other commodities. So all three are either trying to beat the market or follow the market. But what is this market? Well, the stock market, for example, is a representation of companies that are publicly listed in a country or a region. Since you cannot directly buy an exposure to the stock market, you have to use one of these three vehicles to get that exposure indirectly. So these markets can be sliced and diced in many different ways. For example, FTSE 100 represents UK's largest 100 companies that is listed in the stock market, while the S&P 500 market index represents America's top 500 companies that is listed in their stock market. So what do all three different types of funds hold in their portfolio? Starting with an actively managed fund. Say we're looking at an equity fund which is actively managed by a professional fund manager against the benchmark of S&P 500. While the S&P 500 holds 500 of the largest company in America, the fund manager may decide to hold only, say, 30 different companies. And that is driven by the fund manager's conviction. So the fund manager could think that the top 30 companies that they have picked will give you a better or a superior return than overall performance of S&P 500. And so the overall performance of the fund will deviate and can be quite different to the performance that you see of S&P 500. Compared to an actively managed US equity fund, an index fund, on the other hand, will hold exactly what is being held by the market. So if an index fund follows performance of S&P 500, it will hold those 500 companies by their exact weight so that you can also get the same performance of S&P 500. Now, compared to the mutual fund, both active and passive, ETF, on the other hand, will track whatever it says it will track. For example, it can track the performance of S&P 500 like an index fund, or it can track performance of, say, gold or oil or any other commodities out there. So ETF allows you to get an underlying investment performance of an asset class which may not be easy to get hold of physically. For example, you wouldn't want to go and buy lots of gold bars and store them in your house, while you can track an ETF which follows the performance of gold, hence giving you a similar amount of capital return. So how and when can we go about to invest in these three types of funds? Well, to understand that better, observe my professionally drawn cartoon here. Here is a fund manager, and here is someone, an investor, maybe it's me, who's got some money to invest in the stock market. Starting with the mutual funds, both active and index fund. Because they're both actually managed by a fund manager, yes, an index fund also got a fund manager, but they passively manages the fund, so they don't get any extra fee. Anyway, because they're managed by the fund manager, I cannot directly go into the stock market and place a deal. I will first have to tell of my intention to the fund manager using my platform such as Hargreaves Lansdown that I want to buy some units in their fund. The fund manager will then take my money and invest it into the stock market as they seem fit. So as you can already imagine, there is a lag between when I want to invest my money and when my money gets invested. Usually I can only trade a mutual fund, both active and index, just once a day. Compared to that, the exchange traded fund, or the ETF, as the name suggests, they are traded directly on the exchange or the stock market, and so we're able to make investment in them any time of the day. For example, if I like an ETF and I see the price of that ETF drop by 5% and I want to buy that ETF at that exact price, I can do it just like a stock or a share. That basically means that an ETF trades just like a single stock, and I can buy it whenever I like as long as the stock market or the exchange is open. And so I hope you can already guess that this trading is not gonna be free. We usually have to pay a trading cost when we're investing in ETF, just like we have to pay a trading cost when you are buying a single stock or a share. So there is definitely a trade-off between trading time and trading cost when it comes to all three different types of funds. Talking of cost, the main type of cost when you're investing in a fund is called the annual management cost, or the TER, total expense ratio. By now you must already know why actively managed mutual funds get a very bad rep. and that is due to their high fees or high cost. An actively managed mutual fund can charge you anything from 0.5% to say 3% per annum. Compared to actively managed funds, the index fund, out of the three actually, index funds have the lowest fees. You can expect to pay a fee of less than 0.15%. And that's because the index fund is simply tracking a boring index, and there's usually a fund manager behind it where his job is simply to send buy orders and sell order into the market and not make any active investment decisions. Now, finally, ETF. You may be surprised to know that ETF fees are not as cheap as you would think. Even though most of the ETFs are passively managed, very little portion are actively managed. Even the passively managed ETF, they can charge you as high as one of the actively managed mutual funds. And the fees of these ETF will vary depending on what exactly they are trying to track. If the market that they're trying to track incurs a higher cost or it's much harder to track, then they can get away with charging you a bit more money compared to a mutual fund. So don't fall into the trap of thinking that ETFs are always the cheapest option. Let's do a list of good and bad for all three different types of fund. Starting with the actively managed mutual fund, there are plenty of advantages behind investing in an actively managed fund. The first is definitely the potential of having a much higher return compared to the market. While beating the market can be quite difficult, but there are definitely some good fund managers out there who can potentially give you a much higher return compared to the market. Tying to this is the second reason of having access to more innovative and niche type of product. Some fund managers actually specializes in a very tiny part of the stock market which is not well known to rest of the world, and so those funds can offer you exposure to a very niche part of the stock market which can potentially give you a much higher return than simply observing or tracking an overall index performance. And the third reason is very obvious, which is the fact that you don't really have to worry about what's happening to the underlying stock that your fund manager holds. You're basically paying the fund managers to stay up late at night worrying about the stocks while you can go and relax. And that's a really important point actually, because the stock market is very volatile, especially single stock. And every time a negative news hits the market, it can really send the share price plummeting. News can involve something as small as a sell-side analyst downgrading the stock, or the change in management of the company, or the fact that the company stopped paying dividends. All this information, they're constantly coming in. So it's really hard for an individual like me and you to follow those information every single day. Following news of one company is bad enough. Imagine trying to follow 15 or even 20 different companies on a day-to-day basis. And that is one of the reasons why we pay a little bit more to the fund managers, since on a day-to-day basis, they're actually following all these companies that they're investing in. They're meeting the management of the company. They're aware of all the earnings calls that's coming in. They're aware of any changes that's happening to the management so that they can make a well-informed decisions. And the fourth advantage is actually shared across all three different types of fund, and it is diversification. Because you're investing in a fund which automatically holds many different types of stocks in them, you're already getting plenty of diversification. And the final advantage of investing in an actively managed mutual fund is the fact the fund manager actually shares with you what companies he's holding and the reason behind why he's holding that company. So you can actually get plenty of good literature and learning from investing in an actively managed mutual fund. Now the disadvantages. The first one is of course the fact that it's pretty hard to find a good fund manager. Only 20% of active fund managers have been able to beat the overall stock market benchmark. So while good fund managers are out there, it's actually pretty hard to find them. Second is of course the fees. As I've mentioned, because active management involves the fund manager's specialist skills, they are gonna charge you a much higher fee for their professional decision making. So that's something to keep in mind, because higher fees can ultimately eat away a lot of good performance from your investment. And the third disadvantage is the lack of openness. Because these actively managed funds hold some of the fund managers' unique views, they don't usually give out a list of stocks that they hold in the fund. They will only reveal, say, top 10 holdings in the fund, and even that information comes like with 2 months lag. So you don't get a lot of visibility of companies that are held within an actively managed mutual fund. Now, index fund. The great thing about index fund is definitely the fees. They can be as low as 0.05%. And secondly, because an index fund is essentially a mutual fund, it also offers you the same benefit of an actively managed mutual fund that the ETF don't. So you're easily able to reinvest your dividend and also set up a regular monthly investment without incurring trading costs like an ETF. And the third great thing about an index fund compared to an actively managed mutual fund is the visibility. Because you're investing in an index that is being tracked, you know exactly what stocks you're holding. So the first disadvantage of investing in an index fund is the fact you cannot get higher return than the market. You're bound to get the market return. So when the market goes down by 20%, well, your money will also go down by 20%. An interesting point to note is that during a market crash, actively managed funds actually performs a bit better than an index fund, and that's because the professional fund manager, they're a bit more cautious, so they tend to hold a lot more cash during a volatile market. That way the fund value goes down much less than the overall stock market value. The second disadvantage is the fact it cannot trade like an ETF throughout the day. Because index fund is a mutual fund, you can only trade it once a day. And the third point to note is that some part of the stock market or some sector of the stock market, it is much better to leave it to an expert to cherry pick the best stocks amongst them. An example would be small cap investing or emerging market investing. For example, an emerging market index can hold a lot of different underperforming funds just because they have to hold them, while a professional fund manager can actually specialize in that part of the emerging market and therefore add more value to your investment than simply following an index. So the obvious advantage of an ETF is the fact they trade like a stock. So you can buy and sell any time of the day as long as the stock market is open. So it trades like a stock. That's an advantage, of course. And the second advantage is the fact it allows you to track and get exposure to a very niche or specialist part of a market or an investment. So you can put specialist exposure, i.e. oil. So you don't have to go and buy barrels of oil. You can literally buy an ETF that follows price of oil. The third advantage is that it could be cheaper. So I'm gonna write could because they're not always. Could be cheaper than your actively managed mutual fund. So although their annual fee could be much cheaper than an active fund, you do have to pay trading costs because they trade just like a stock. So you do have to pay a fee every time you buy and sell units of an ETF, and that can really add up depending on how frequently you're buying and selling. Sticking to trading costs, another big disadvantage of an ETF is that just like a stock, they have two prices, a bid and an ask. So we should be aware of the spread between the price that we pay when we buy a share, called the ask price, and the price that you get when we sell a share, called the bid price. So it's important to always take note of their bid-ask spread. It should be available in the fact sheets of the ETF. And the third disadvantage point I wanted to mention on ETF is the fact they may not provide you a lot of option when it comes to reinvesting your dividend, because not ETF provides you with the option of an accumulating or an income share class. Some are simply income share class, so you don't have the option of easily reinvesting your dividend income. Okay guys, that's all for today. Do let me know which of the three funds you prefer in the comment section below, and until next time, look after yourself and your money.